Welcome back to the second half of the Future Show. We're less than 60 minutes away from the cash open for stocks on Wall Street, and kind of a mixed open here. It looks like 3 of the 4 majors in positive territory. We're ramping up the energy into the second half of the show. To help us with that, Scott Bauer, the CEO of Prosper Trading Academy, joins us. Scott, welcome. Happy Friday. Let's begin with the move lower in the U.S. dollar. The green back below 100.
How about it? I mean, this is a pretty significant move, and I know there's been a lot of short bets on the dollar in the market over the last months accumulating, and this to me is very surprising, Ben, that we dipped under par, that we dipped under 100 here, and it all really has to do with the inflation data that we received this week and the moderation once again, perhaps, of what that terminal rate is going to be, and we're seeing other currencies really play catch up against the dollar here.
Yeah, you know, we were talking about it at the top of the show in terms of some of the comments from Fed speakers here. I pointed to comments from Waller, who said that the data this week, he said it warmed his heart, but he's got to think with his head. It sounds like most of them seem to be leaning towards further rate hikes to come this year.
Yeah, absolutely, the one in a couple weeks in July. But if you look at the CME FedWatch tool, which, you know, gives out the probabilities of potential raises in the future, September is pretty much off the board. In November, which just last week, before all the inflation data, just last week, there was over a 50% probability of another hike in November. That's now down to about 12 or 13%. So I think that's what the market is tuning into. That's what the market really likes here. The July one, that's a given. I mean, that's a 98% probability. But the market is looking and saying, okay, maybe again we're at or close to that terminal rate. I mean, we've been here before, Ben, right? Over the last 6 or 9 months, we've thought numerous times that we've been at the top of the range. That's what the market is kind of hanging its hat on right now.
Yeah, we talk about the fine-tuning aspect as we work our way towards the end of this cycle, and how this is kind of where the hard work starts, right? In many ways, kind of getting inflation down to that 2% level and sort of tweaking rates here. And we saw that with the Bank of Canada. They paused and they had to come back this week with the rate hike ultimately. Scott, how much of a fly in the ointment, I guess, will this data be here this morning? It looks like imports, export prices coming in negative across the board here. Export prices down 12% on a year-over-year basis, month-over-month coming in below expectations. Also, here we can see the data, the import side of things as well. I mean, not necessarily what we wanted to see, but probably not going to derail some of this momentum we have been seeing.
Exactly. I mean, you would have liked to have seen a little bit different report here, but it's on to the next now. I mean, this is, you know, the big ones this week were CPI, PPI. This is really an afterthought. I think this is going to be a blip on the radar screen. And now, you know, the Fed's going to be moving into their quiet period coming up here. And we've got that meeting, I think, on the 25th and, excuse me, the 25th and 26th. So that's what all eyes are going to be looking at.
Talking about the Fed here and the U.S. dollar, obviously an interesting move in rates this week. The 10-year back to 4% and then a sharp retreat off that upper level. The 2-year, a significant decline from above 5%.
Absolutely. So now you're seeing the 10-year back around, what, 376, 377, when it was, you know, just above 4%, as you said. And also, you know, the 2-year. But also we saw, you know, about 4, 6, 8 weeks ago, we saw a contraction in the 210 spread. We saw that, and then it expanded back out again over the last couple of weeks. Now it's back under 1. It's about, you know, 90 basis points or so right now. And I think what that's doing is saying that, okay, there's a little bit of pressure off now on these near-term rates. And that's all because of this inflation data. That's because of, you know, people saying that maybe we're getting to the top of that terminal rate. I think what's really surprising, Ben, when I look back, and something that maybe people aren't really focusing on here, is since the Fed started raising rates in March of 2022, the S&Ps are actually up 3%. That's pretty phenomenal, even though it's been a wild ride.
You know, and as I think of that, Scott, in terms of that initiative that we've seen as far as the Fed raising rates, the market's reaction to and expectations that's going to continue. We're also seeing that play out globally, right? And that's what's bolstered some of the foreign currencies. We saw the British pound this week ahead of expectations from the Bank of England. I mentioned the Bank of Canada as well, but across the board here, the euro all the way through to the Swiss franc, I mean, you've got prices on the rise.
And the yen especially.
Absolutely.
So what we're seeing is, moderation here, or at least, the hopes of that terminal rate, but other central banks still being fairly aggressive. So now you're really seeing a lot of catch up, which we have talked about recently, but you're seeing a lot of catch up as other central banks are still, they've got the pedal to the metal here, and we're, maybe getting towards that easing portion of this cycle.
Scott, a lot of what we're seeing here, kind of tying back to what you were talking about in terms of the Fed, when they started this initiative, this cycle, raising rates, the yield curve inverting, a lot of what we're seeing here is based on some of these recession concerns being pushed back.
Yep.
Obviously, the inflation data kind of feeding into that without the Fed having to raise rates more aggressively to combat inflation on the softer than expected data, pushing back those recession concerns. But we also keep leaning on labor conditions here in the U.S. I mean, even the jobless numbers this week, those were pretty strong numbers.
They were really strong numbers, especially coming off the euphoria of what we got last week with the June report. And that's going to continue to be, the thorn in the side, if you will, of the Fed moving forward. And they're just going to have to deal with it. And, as a currency, the dollar is going to have to reflect that, the labor market is really just not softening as much as they want it to. And perhaps that's not a bad thing. If we can get to this soft landing with the labor market continuing the way it is, that's the Garden of Eden. That's the idyllic scenario that the Fed wants here. I'm not sure that's going to happen, but that's still definitely the stickiness that we're seeing in the labor market.